Welcome to Bond Pricing 4 on the Investment Analysis playlist. I'd like to talk now about factors that affect yield to maturity. So the yield to maturity of any bond is a function of, or depends upon, coupon rate, maturity, default probability, liquidity, and tax status, and finally option-like features. So the yield to maturity exhibited by a bond, okay, will depend upon, but there's a function of coupon rate, maturity, default probability, liquidity, tax status, and the option-like features of the bond. So what we're going to look at is the influence on yield to maturity of each of these under the assumption that nothing else is changing except either coupon rate or maturity or default probability, but one at a time. All right, so think about it. If the bond price can't change, if nothing can change, but we suddenly increase the coupon rate, well, yield to maturity is going to increase. And if we suddenly decrease the coupon rate, yield to maturity would decrease. So there's a positive relationship between coupon rate and yield to maturity, okay? And if we were to then just consider maturity, nothing else changes, coupon rate stays the same, default probability, bond price, everything stays the same, but we increase maturity, okay? Then what would happen is yield to maturity would increase, okay? Third issue, if we increase default probability, okay, if we increase the default probability of a bond, then the bond's riskier. Common sense probably tells you that the yield to maturity will increase. If default probability decreases, yield to maturity would decrease, okay? Now what about liquidity? Liquidity is the ability to get into or out of some asset with little or no transaction costs, okay? If liquidity is low, that means the bid-ask spread in the bond will be wide, and hence near simultaneous buy-sells will cost you a lot of money, okay? The bid-ask spread would be wide. So the more liquid the bond is, the lower the spread can be, and hence, relatively speaking, the lower the yield. Illiquid bonds have higher yield to maturity. What about tax status? Well, some bonds are not taxable at both the federal and state levels. And, for example, a California resident buying a bond issued by the state of California would be, generally speaking, buying a tax-free bond, okay? But that's very interesting. So the yield to maturity in a tax-free bond would be expected to be lower than the yield to maturity on a bond that had income that was fully taxable, okay? But what's relevant is your after-tax yield to maturity, and the pre-tax and after-tax yield to maturity on a municipal bond, well, they're the same. And so the tax status of the bond will impact YTM. Tax-free bonds will have lower YTMs. By the way, you never want to compare after-tax or pre-tax yields to maturity on bonds and then make a decision, because the bonds may very well be in different risk categories. So keep that in mind. It's important to have, either be comparing after-tax returns or even pre-tax returns sometime. But in choosing between bonds, you have to consider potential differences in risk, okay? Now, the last idea is a little more complex, and we'll talk about it quite a bit. And this is noting that the yield to maturity of a bond depends upon the option-like features of the bond. That makes sense. If a bond has more desirable features, then the yield to maturity for the bond could be lower. Investors might, all else equal, they'd be willing to accept a lower yield if there were neat things, in their opinion, with respect to the bond's option-like features. Well, what are we talking about? Let's look at a few option-like features. The first one we'll look at is a category referred to as callable bonds. Now, many bonds are indeed callable, risky and risk-free bonds. And a callable bond is a bond that, for some portion of its life, the issuer is able to force the bond holders to buy the bond, to sell the bond, rather, back to the issuing corporation. Usually there's something referred to as a call protect period. That's a period of time during which the corporation is not allowed to call the bond, okay? Maybe it's half the bond's life, okay? So callable bonds. Obviously, the issuing firm gets a benefit by issuing bonds that are callable, okay? In other words, when is a corporation going to call bonds? Well, it's going to call bonds when it's in their best interest to do so. When would that be? Well, when interest rates in the market at which they can borrow fall, then the issuing corporation could call these bonds and then refinance their borrowing at a lower interest rate. So maybe these bonds had a 4% coupon rate, and maybe now interest rates that the firm would be able to issue bonds at is 2%. The firm's going to do it at $100,000 of borrowed funds. That would make the periodic interest expense fall from $4 million to $2 million. So firms are going to call their bonds when they can. But it's also interesting to realize that when a bond is callable, although the benefit accrues to the issuing firm, we can't forget the fact that the entities purchasing the bonds are well aware of that. And therefore, it's logical to assume that they're going to demand, via the interaction of demand and supply forces, they're going to demand higher coupon rates on their bonds when the bonds are callable. Okay? So it's an interesting idea blend here, in that you got demand and supply forces interacting to determine what the coupon rate would be on a callable bond. All right, so let's say a bond has a 20-period maturity. Maybe the bond is callable at date 11. Bonds are usually callable only on coupon payment dates. So this, this is a little more, it's half its life, it's call protected. Then the first time it could be called is date 11. And when the bond is called, what the investor will get will be the $1,000 maturity value, plus the coupon payment due on that date, plus something referred to as a call premium. Now, the size of a call premium might be one period or 1 year's worth of interest if the bond is called, say, the first time it can be called date 11, but that call premium amount will fall in size if the bond is called later on in the call protect period. Okay? But these are the three sources of funds that cash flows, rather, that are received by a bondholder if the bond is indeed called. And it's interesting how this works. You might need to know the following. Let's say a bond has a 20-period life and it's callable at date 11, and then at date 9, the yield to maturity on the bond at, say, date 9 plus yield to maturity sub date 9 plus 1 minute. So 1 minute later, the yield to maturity in the bond becomes 3%. Okay? And probably more importantly, the expected yield to maturity at, say, date 11, when the bond is first callable, is also 3%. Okay? Well, you might ask, what is the price of the bond at date 9? Now, we assume we've already received a coupon payment at date 9. And so, it's date 9 now, and there's date 10, the original dates, date 9, original date 10, original date 11, 12, 13, all the way out to 20, okay? Original dates. But if we are at date 9 in our analysis, then date 9 is kind of the new now, and date 10 is 1 period away, date 11 is 2 periods away, etc. Excuse me. So, an important question is, what's the price of the bond? What's a reasonable assumption as to the price of the bond? And in this case, because the yield to maturity is expected to remain at 3%, maybe the bond initially had a coupon rate of 4%. Okay, the bond has a coupon rate of 4%, and now yields in the marketplace change. Now, the coupon rate's not going to change, but what we're showing here is that the price of the bond is not going to be, the price of the bond at date 9 is not going to be the present value of 40 at date 10, 11, 12, 13, all the way out to 40 plus 1,000 at date 20. That's not going to be what it is, okay? Rather, remember, the value of anything is the present value of all the cash flows expected to emanate from that asset. And in this special case, given the information about the change in market interest rates and expected future yields, the only cash flows coming from this bond will be the cash flow at date 10 and the cash flow at date 11 when the bond is called. And so the cash flow at date 10 would be 40, but the cash flow at date 11 would be, let's think, you got the $1,000 payment because the bond is being called. We got the $40 coupon payment ready to be paid, due on that date, and then the call premiums of, say, another $40. So the cash flows from this bond, really, as of the original date 9, which is the new date 0, are really 40 and 1,080. This is the real cash flow stream of the bond. Sorry, that's supposed to be date 2. Okay, so now the price of the bond then at date 0, which is the original date 9, okay, then becomes, so the value at date 0 will be 40 divided by 1 plus the new yield. New yield is 3%. 1 plus the new yield, plus 1,080 divided by 1 plus the new yield squared, because we're going back in time 2 periods. And so that would be the price of the bond, and rather than what it would be if the bond was not callable. If the bond was not callable, then we'd have cash flows as indicated here, and the price of the bond would be, well, think about it. We've got 11 payments, starting at 10, ending at 20, 11 payments of $40. So I'll say 40 times a PVIFA, where R is equal to 0.03, and N, the number of cash flows in the annuity, is 11. And then plus the $1,000 cash flow payable 11 periods from now at the original day 20, multiplied by a present value interest factor, where R is also equal to 0.03, and N is also equal to 11, but of course, from watching my Time Value of Money videos, you are well aware of the fact that the meaning of This N is the number of cash flows in the annuity, and the meaning of that N is the number of cash flows we're moving back in time. Okay? So the value of the bond, because it's callable, is not, repeat, not this, but rather is, repeat, is this. Okay? So that's interesting. That's how callable bonds work. Well, let's talk about another option-like feature associated with bonds. And this one's going to be a convertible bond. Excuse me. Now, a convertible bond is a bond issued by a company that is able to be magically transformed or converted into a certain number of shares of stock. Firms issue these types of bonds because by doing so, by offering some equity stake, some potential equity stake in the firm, investors who like the ability to have an equity stake, perhaps, in the firm, will be willing to accept a lower coupon rate on the bond. So this is another way for a young firm to raise funds without having to pay what they consider excess coupon payments to the bond holders. So convertible bonds, convertible into a certain number of shares of stock. Let's just say we have a bond that is convertible into 10 shares of the stock of the firm that issued the convertible bond. Okay, so 10 shares. And let's say the price of the stock for the firm that's issuing the bonds right now, say at date 0, is $60 a share. And this bond that can be converted into 10 shares, then is such that no one would rationally, let's just say the bond has a price of $1,000, no one would rationally pay $1,000 to buy 10 shares of, if the intent was just to immediately convert the bond into stock shares. No one would buy this bond. Rather, they just go out and buy the 10 shares at $60 each and spend $600. Instead of spending, we'll assume $1,000, bond priced at par, to buy the bond. But the idea is they must have some expectation that the stock of the price some date in the future, I'll call it the price of the stock, FUT, subscript, maybe they think that's going to be $150 a share. Well, you can see the idea here, that is, if the price is 150 and the bond is able to be converted into 10 shares, you'll have $1,500 in value. Okay? So, if you expect stock price to rise, you need not convert the bond. You may convert the bond if you wish, but you need not. The reason you need not convert the bond is that at least while the convertible bond is in existence, hasn't matured, its price, the price of the convertible bond, has to reflect the stock price. In other words, the price of the bond, the CB, convertible bond, will end up being the maximum of the pure bond value. That's calculating bond values as we have in the past, present value of all the promised coupon payments plus the principal payment at the end. So it's the maximum pure bond value and conversion value. Okay, so the price of the convertible bond, by the way, this is in equilibrium. Equilib is my notation for equilibrium. So in equilibrium, the price of the convertible bond will be the maximum of the pure bond value or the convertible value. So if the stock price is $150 a share, then this convertible bond in equilibrium will have a price $1,500. I can show you why that has to be the price. Because let's look at a circumstance where it wasn't the price. Let's assume, that's a minimum on the price, $1,500. Might be higher, but that's the minimum price, $1,500. Let's see what happens if the bond value is $1,400. What would you do? Well, you would, step one, buy one bond, and the cash flow associated with doing that is the minus $1,400. We assume we pay $1,400 for it. And then you would immediately convert the bond. Okay, so step two is convert bond. Okay, there's no cash flow there. But now you've got 10 shares of stock. And then step three, remember we assumed the price was $150 a share. You sell 100 shares. Okay, we sell them at market price. 150 a share. I'm sorry, I wrote 100 shares here. It's 10 shares, I'm sorry. Make sure you note that, 10 shares, not 100. So you buy one bond, costs you $1,400. Convert the bond, no cost. Now you've got 10 shares of stock, not 100, I'm sorry, 10 shares. Sell 10 shares, and then you receive 150 times 10, or 1,500, and look, you've made $100. Now how many times will you do that? Well, the answer is you'll do it as many times as you can. But it's interesting that if there is a mispricing like that, the actual trades taken by those trying to capture this arbitrage profit, we call them arbitrageurs or wannabe arbitrageurs, as they're doing this, look, they're buying the bond, so they're bidding up its price. They're selling shares, so they're driving down the price. And eventually an equilibrium price will develop between the price of the convertible bond and the shares of the stock that underlies it, such that the excess profit here becomes zero, right? In other words, the arbitrage opportunity disappears. And that little example there is showing you why the price of the bond has to be the maximum of pure bond value or conversion value, okay? Remember, pure bond value is just the bond being valued as a bond itself, ignoring the conversion feature. All right. You should know that convertible bonds are said to be bonds that possess an equity kicker. Just a little something extra in the bond that gives you, as the bond holder or as a bond holder, the potential for share price appreciation. And so they call it an equity kicker. Well, let's look at a second type of equity kicker. And this will be a bond with detachable warrants. Now, what's a warrant? A warrant is a long-lived option. Gives you the right to buy a certain number of shares of stock at a specific price, okay? So bonds with detachable warrants. So the idea, here's a visual. You have a bond, and then here's a warrant, and they are separate. You can tear off the warrant, and if you wanted to, you could sell that warrant, because that warrant, will have its own price. That warrant will have its own price. Okay? So a bond with detachable warrants is such that you can sell the warrant itself and you still own the bond. Okay? So let's say this warrant gives you the right to buy 100 shares of the underlying stock of the warrant, which is the common stock shares of the firm that issued this bond with detachable warrants. So you have a right to buy 100 shares. Maybe the price of the stock of the firm now is, let's say $20 a share, and you have a right to buy 100 shares at $50 a share. See that? Right now, no rational person would buy the bond just to get the warrant, to then exercise the warrant to get 100 shares at $50 each. If they wanted 100 shares, they go out and buy them right now on the market for $20 each. Okay? But the reason people buy these is because they expect the price of the stock at some point in the future to be, well, let's say perhaps $80 a share. Well, let's see what happens if that expectation ends up being correct. What they could do is, if the stock price goes to 80, one thing they could do is they could exercise their warrant. And what would they do if they exercise the warrant? What would happen? Well, step one is exercise the warrant, okay? And the cash flow associated with that is, well, the right to buy 100 shares at 50. There's a $5,000 cash outflow there. And then if they do this, then that means they'll own 100 shares. And so the second thing they can do is they can sell the shares, SHS shares, at $80. So 100 shares at $80 each is $8,000. And so we're up $3,000. So that's one thing you could do. You could exercise your warrant and you could make money. But this shows us, this is why people like warrants. If the stock price does rise, they can do very well here and make $3,000. Okay? But you wouldn't exercise your warrant right away when the stock was still 20. That would be irrational, illogical, foolish. All right, well, but you need not exercise your warrant because the market price of the warrant parentheses in equilibrium will be greater than or equal to, I'll go like this, and I'll draw a line that looks like this from that little box to that 3,000. In this case, the market price of the warrant will be at least 3,000. Okay, so it'll be the stock price minus in this example, the $50 price we're able to pay is called an exercise price or a strike price. Exercise price, strike price. They're synonyms, and they're often referred to as X. So S minus X times 100 would be the value of the warrant. So I'll say the warrant price, WP, would be S minus X times 100, or maybe I should say greater than or equal to. That's a little too advanced for now. Yeah, could be worth even more because the stock price might go higher and somebody might find that a possibility appealing and be willing to pay for it. So let's just see in this prior example, stock price was 80, strike price was 50 times 100. So 80 minus 50 is 30 times 100 is 3,000. And yeah, that's the value there. So that's how, that's how bonds with detachable warrants work. And so now what I've shown you in this video is the factors that influence a bond's yield to maturity And we spent some time and went into depth on the option-like features of bonds. Thank you for watching.